Friends, in this second income tax digest, we start with the updates on the Income Tax Act Comprehensive Review or Revamp. Very recently, the Honorable Finance Minister along with the Revenue Secretary, CBDT Chairman and other high officials of CBDT have held a meeting on the Income Tax Act Revamp or Comprehensive Review, where 22 committees have been formed to review various provisions under income tax. It has been published via a press release that more than 6,500 suggestions across the country on the Income Tax Act Revamp or Comprehensive Review have been received by the Ministry of Finance, CBDT. So, in case you want to give your suggestion on the policy matters on Income Tax Act Comprehensive Review, you may go to our last video where we have shared the link on which you have to click and provide your suggestions to the Ministry of Finance in their website. In this video, we will also discuss on a major issue wherein trade, industry and taxpayers are representing widely before the Honorable Ministry of Finance for revamping by comprehensive review of the Income Tax Act. It is on revamping of TDS and TCS provisions under income tax. As of now, there are 71 sections starting from section 190 to section 206 CCA, which covers various provisions on TDS or TCS. It covers the leviability of TDS, TCS, various payments which are made or collected on which TDS or TCS are applicable, as well as procedural issues in TDS and TCS. It is our suggestion that these 71 sections may be clubbed into 3 or 4 sections, or better still, it may be clubbed in a comprehensive schedule wherein the rates would be in the schedule, just like say the Customs Tariff Act, and any explanation or any other comments or any other provisions related to those entries may be in the form of schedule notes. So, you might be wiping out 71 out of the 294 sections on income tax and making the act simpler and non-litigative. The second suggestion on TDS or TCS, well, every year we hear on the statistics on the refunds in income tax generated by the CBDT or CPC. Why are these refunds being generated? Because the refunds are being created, and mainly it is due to the high rates of TDS or TCS, which has to be claimed by the taxpayers while filing their income tax return. A lot of the administrative machinery of the Ministry of Finance is also stuck up in generating these TDS or TCS refunds while the income tax return, and therefore a process has been started in this Finance Act number 2 of 2024. It has to be taken forward further by reducing the TDS or TCS rates. A third suggestion on TDS or TCS is to remove the overlapping. For example, 194Q and 206C 1H. TDS or TCS on the sale of goods over rupees 50 lakh by those taxpayers who have a turnover of more than 10 crore rupees. More so, these overlapping provisions are sometimes very difficult to implement. In case a buyer of goods does not deduct TDS under 194Q, then there is a liability on the seller to collect TCS under 206C 1H. And when does the seller know that the buyer has not deducted the TCS? It is at the fag end of the year. Penalties and interest flow consequently. So, it is our suggestion to remove these overlapping provisions in TDS and TCS also in this Income Tax Act revamp or review. The next issue which we will discuss in this week is whether all payments which are found to be excessive under section 40A(3) made to specified persons should be disallowed. Well, in case these payments are expedient and absolutely necessary for businesses, if the payees are identifiable and if these transactions are found to be genuine, then even if there is an excessive payment to specified person, it may not be disallowed under section 40A(3) as was held by the Honorable ITAT Chandigarh in the case of Shri Munish Arora. Well, the case in this matter was where certain specified person held an event of an event management company ransom and where they had to be paid immediately so that the event does not stop. In this case, the ITAT Chandigarh has held that it was expedient for the business to run efficiently and therefore the disallowance under 40A(3) would not be held applicable in this case. Another issue in foreign taxation is whether a payment is to be construed as a license fee or as a royalty for purchase of copyrights. Well, in case a resident pays to a non-resident who does not have any permanent establishment in India, a payment as a royalty for copyright, then TDS under 195 is applicable and the same is liable to be taxed in India. Now the question is how to distinguish between a royalty and a mere license fee. Well, in case a payment for a software, for example say, is made where the software cannot be reproduced, cannot be used by any other person other than the transferee, cannot be transferred to any other person, and there is an end user agreement for the license fee which specifies all these conditions, then it was held by the ITAT Chennai in the case of Cognify Pte Limited that such payment would be considered as license fee payment and not royalty payments and would not be taxable in India. It upheld the Honorable Apex Court's judgment in the case of Engineering Analysis and Center of Excellence. Therefore, when one is getting the form 15 CA/CB for a payment for a license fee or copyright, one has to keep these in mind. Another important issue which businesses face is whether the capital reserve generated while amalgamation is liable to be taxed, and specifically after 28(4) of the Income Tax Act has come more into visibility. Now it is contended by many officers that this capital reserve which is generated while amalgamation through accounting entry as per accounting standard is liable to be taxed as perquisite or benefit. However, a perquisite or benefit has to be there. It has to be in revenue nature and it has to be non-monetary for the purpose of business profession. In case a capital reserve is generated during amalgamation, nobody becomes rich or poorer. It is a pure capital nature reserve and therefore it was held in the case of Samagra Max Wealth Private Limited by the Honorable ITAT Mumbai that a capital reserve generated in case of amalgamation which is not considered to be as a transfer under section 47 is not liable to be taxed as it is capital in nature and it is exempt under the Income Tax Act. Another issue which almost all taxpayers face is an issue as to what interest is liable to income tax and what is not liable to income tax. For this, there is a doctrine and a general broad principle which all taxpayers should keep in mind. The principle is that interest takes the color of the underlying principal. So if the main amount is taxable or the principal amount is taxable or the income is taxable, then the interest correspondingly would be taxable. If the principal or the income is not taxable, then the interest would not be taxable and it would take the color of the principal amount itself. So in case a compensation is received from the collector in case of acquisition of land under Land Acquisition Act 1894 in the form of interest, then the question is whether this interest would be taxable or non-taxable under Income Tax Act. Now, interest under Land Acquisition Act can be received under section 28 or 34. Section 28 is an interest on an additional compensation which was not granted initially by the collector. However, interest under section 34 is due to the delayed compensation paid by the collector, wherein the compensation was paid after taking over the land. So, it was held by the Honorable Apex Court in the case of Ghanashyam HUF that interest received under section 28 of the Land Acquisition Act is not liable to be taxed, being capital in nature and which partakes the nature of the compensation itself, and the same is exempt under section 10 subsection 37 of the Income Tax Act. But an interest under section 34 for delayed compensation, that is liable to be taxed under the Income Tax Act under section 56(2) read with section 145 capital A, and deduction under section 57 can be claimed at the rate of 50% of such interest amount. So friends, these are the major developments in this week. Thank you for watching. Do like, share and subscribe to this channel. Stay tuned until we come out with our next video in the next week. Thank you very much.